We were not waiting around for the call. I need to make a few acknowledgements, and then I'll talk a little bit about my research. First, I'm very happy to be sharing this prize with Douglas Diamond and Philip Dybvig, whose work on bank runs was very seminal, had a big impact on me back in the early 80s when I was working on these issues. So I'm very pleased to be sharing the prize with them. I also want to acknowledge many co-authors and colleagues. If you look through my vita, you'll see many people who I've worked with. But I want to give special mention to Mark Gertler at New York University, who I worked with from the time we both finished our PhDs. And we talked about these issues and wrote many papers together. And I just can't say enough about what he's done on these issues, including work that he did when I was busy, spending time in Washington. He continued the research. So many thanks to Mark. Of course, I had tremendous support from my family. My wife Anna is here. Anna, stand up. Thank you. There wasn't enough notice for our kids, Joel and Alyssa, to attend, but they did know about it before we did, so that counts for something. Let me talk just very briefly about the research that was cited by the committee. They cited in particular my 1983 39-year-old American Economic Review paper on banking in the Great Depression. Looking back on it, it looks a little bit primitive after 40 years, but it did have, I think, some fruitful ideas. In particular, at the time I was working on this, which was at the height of real business cycle theory and the like, people didn't think of the financial system as being an important part of the business cycle, an important part of what was driving the economy. As one professor told me when I gave this paper, the financial system is just a veil. It just tells you who owns what. It doesn't have any independent effect on the economy. But what I argued, and what this paper introduced, or at least highlighted, was the idea that developments in financial system can have important macroeconomic effects. In particular, they can affect the business cycle through what Mark Gertler and I call the financial accelerator mechanism, as well as, of course, creating major crises, as we saw in 2008. So the idea, it's the simple idea that the financial system can be a driver of economic activity and unemployment was something that this paper emphasized, was not conventional wisdom in 1983. Now, the underlying economics behind this approach has to do with the economics of asymmetric information. When borrowers come to lenders, the borrowers have more information about their own ability to repay, their own plans, their own finances, than the lender does. And that creates costs because the lender has to learn about the borrower's capacity to repay before making a loan. This is what's called an agency problem in theoretical economics, that in a sense, the lender is looking to the borrower to use the money that is lent in a productive way. Now, one of the insights here is that in standard principal agent problems, that when the agent has a good bit of wealth, the principal agent problems become simpler because the agent can cover losses that might occur due to their own actions. So in particular, imagine a borrower who wants to buy a house, makes a large down payment. That makes it easy for the bank to make the loan because they know that if the person doesn't keep the house up, for example, that they'll be made whole because of the down payment. Likewise, a bank with a strong capital position can go into the market and borrow and not be concerned about being rationed in the credit market. So in good times, when banks and borrowers, and my paper looked at both sides of that, not just the banks, when banks and borrowers are in good, strong financial condition, then the credit process is smooth, lending takes place, people are aware that credit is available should they need it, and that provides support for the economy. In periods of crisis, the credit mechanism breaks down in that nobody knows for sure who's solvent, nobody knows for sure what the wealth or collateral of other agents of the economy is, and that can create tremendous problems in the credit mechanism, and that in turn can have economic effects. Now, these ideas came about to me through cross-fertilization in a way, because I did graduate from MIT with Sam Fisher as my advisor, and that involved a lot of study of both monetary issues, and also I got a very strong interest in the Great Depression, which again seemed to go against the idea that the financial system was irrelevant to what's happening in the economy. It seemed like it was very relevant, and I wanted to understand better how. And then I took my first job at Stanford Business School, and at the time, people like Bob Wilson and Paul Milgram, who were recent winners of this prize, were doing research on the principal agent problems, and the combination of the history, the Friedman and Schwartz monetary approach to depression, and the theoretical models of Wilson and al. Helped me think about this issue. Now, this work, as I said, it looks kind of primitive from this vantage point, but it did give rise, along with other work, to a pretty substantial literature of many different types. I did, for example, historical work with Harold James, who is a well-known historian at Princeton. We looked at a large set of countries during the 1930s, and we found that the countries that had big banking crises and where the gold standard prevailed, which meant that they had deflationary monetary contractions, that those were the countries that suffered the most in terms of output and employment. We've done macro models. Like I said, standard macro models, even until relatively recently, at the Federal Reserve and elsewhere, did not have much room for an independent financial system in the model of the economy. One of the early examples of doing that was a paper I wrote with Mark Gertler and Simon Gilchrist that included so-called financial frictions, but basically this idea that financial markets and financial institutions matter for the evolution of the economy. And the last paper I'll mention is one that I did here for Brookings, in the Brookings papers in 2018, which looked at empirically at the effects of different phases of the global financial crisis and the effects they had on the American economy, and found very, very strong connections between the phases of the crisis and the responses of real activity. So I think that this approach, this idea, starting off, again, in a very simple verbal description, has been productive and has led to a line of research. Now, of course, a scientist should do real-world applications of their ideas, and so from 2006 to 2014, I was involved in a global financial crisis where the problems in the financial sector caused tremendous problems in the real economy, both here and around the world. And this, and thinking about these issues made me very determined to do everything I could, along with my other policymakers, my colleagues, to try to prevent the financial system from melting down, because I strongly believed that if that happened, that would bring down the rest of the economy. I also tried to keep monetary policy expansionary to avoid deflation or disinflation, which earlier research going back to Irving Fisher has shown makes borrowers worse off and in turn also can add to financial distress. So again, practical application. I hope it was helpful and informative. Of course, as you know, the world is a very complicated place, and the models don't have any room for politics and lots of other things that were going on. But it did help me think about these issues in 2008. All right, so thanks for bearing with me on this economics lecture, and I will be happy to take some questions. Stephanie is going to moderate. Okay.
Okay, so we're now Ben is going to take some questions from the audience. If you are watching online, please send questions to events@brookings.edu, or you can use the hashtag Ben Bernanke Nobel. And for those in the room, if you raise your hand, I'll call on you, and someone will hand you a microphone, and please state your name and organization first.
Stan, sorry. Hi, my name is Greg Ip with the Wall Street Journal. Congratulations, Ben.
Thank you, Greg.
Your work, I think, went beyond Diamond did Big by emphasizing not just the intermediary significance in the knowledge base of banks, but the importance of collateral values. And you mentioned the Irving Fisher work on debt deflation and how deflations destroy collateral values, and therefore even healthy banks will not lend. So, and this also, I think, played a part in yours and Mark's work on financial accelerator. So one of the things I think you've referenced in your remarks was during the great global financial crisis, it was important to avoid deflation because of those knock-on effects. Of course, that was a period of low to very low, excessively low inflation. Today we have the opposite. We have high inflation, and collateral values have actually been going up. So taking what you learned from that period to the present, there's a reversal in those inflation risks suggests that, according to the mechanisms you've identified, there's much less risk of those dynamics being recreated in today's environment.
Well, the simple point is that inflation helps debtors and deflation hurts debtors. So in the sense that homeowners now have more equity in their home than they did 2 years ago, that protects them and protects that sector to some extent from problems. But then, of course, on the other side, you have the banks, and do they have enough lending power? And the good news that has been emphasized by policymakers is that following the global financial crisis, there was a substantial increase in the amount of capital held by banks. And I'm not here to comment on the specifics of what capital levels are, et cetera. Obviously, I'm not no longer an insider on those discussions. But my sense is that banks in general are a good bit better capitalized than they were in the global financial crisis, and therefore should be better prepared to meet whatever challenges they face. I guess I would add that the word banks is used in this literature kind of loosely to mean almost any lender. And of course, in America, about half our lending is done by non-bank lenders, so-called shadow banks. And I think that when we look at the safety and soundness of the financial system, that we should look not only at the banks, but also at the non-bank lenders, who in fact were an important part of the problem in 2008.
Thanks. Other questions? Oh, Gina.
Hi, Gina Smilik with the New York Times. Congratulations on the award. Thanks for taking our questions. I wonder if you could talk a little bit about how the research that you've been awarded for today and sort of the body of work that all three laureates have produced bear on the current moment. Obviously we have a lot of financial stability risks emanating both from abroad and here domestically, and I wonder, what policymakers should keep in mind from your research as they approach this moment.
Well, there is a very big difference between this episode and the global financial crisis, in that the global financial crisis was essentially caused by weakness in the financial system and by weakness in borrowers, whereas this crisis was caused by an external event, namely the pandemic. And we came into the pandemic with, as I said before, a strong banking, strong financial system. We did find some weaknesses in March 2020 that the Fed had to address in some particular markets, including the shadow banking system, as I mentioned before. But overall, we've not had the financial crises, the near collapse of major institutions, those kinds of issues that were important in 2008. So the United States, I think, there are issues of financial stability in various markets, et cetera. But we're certainly not in anything like the dire straits we were in 14 years ago. Now, I think more broadly, it has been pointed out that besides the United States, of course, there are many other places where financial stability issues are a concern. I don't know what bank regulators are seeing in Europe, but clearly there's going to be a lot of financial pressure coming from the shutdown of natural gas from Soviet Union, from Russia. Also, emerging markets are facing a very strong dollar and a lot of capital outflows. So they too could be facing issues. So I don't have a specific, I should be careful, I don't have a specific risk to point to, but it is true that even if financial problems don't begin an episode, over time, if the episode makes conditions and financial conditions worse, they can add to the problem and intensify it. So that's something I think that we really have to pay close attention to.
Thank you. Thank you. Rich Miller with Bloomberg. Congratulations again, Ben. Your research is also concentrated on inflation targets. Not that wasn't, and the 2% target that you guys adopted in 2012, I believe it was. There's a lot of chatter now about that. Given how high inflation is and how painful, to use Chairman Powell's word, it might be to get it down, and we should rethink the 2% target, and that maybe it was set too low. I wonder if you could talk a bit about that. Thank you.
Yes, a lot of my work was on inflation targets, and I viewed inflation targets as important because they were part of the communication process. And one of the things that happened during my tenure at the Fed was we became much more transparent, much more open, tried to explain what we were doing, and inflation targets were part of that. And it was the inflation target itself that was important to me, not the number specifically. Having said that, I think now, given that target is 2%, the Fed has said that it's not, looking to revise that. I think what should be kept in mind is that that inflation target is a medium-term target. It doesn't have to be met all the time. It doesn't have to be met, within 6 months or anything like that. I think that as the Fed's policy actions begin to have their effects on the economy, they will begin to balance the two sides of the dual mandate, and based on that, they'll make a decision about how quickly they need to get back down to 2%. I think changing the target in the middle of a situation where inflation is well above the target would be not good for the Fed's credibility overall.
Hi there, Mary Paulson. I'm a recent college graduate who I learned from your textbooks, your seminal papers. I was just wondering what advice you have for young people who are passionate about economics and who have just been inspired by your work.
Well, one of the lessons of my life is that you never know what's going to happen. I've had people say, I want to be on the board of governors someday, and I say, there's no way, there's no specific path that you can take that will give you a good chance of that happening. It's random in the sense that, you have an opportunity here, an opportunity there. I think, so I guess my advice to the recent college graduate is to develop skills, to learn, but don't overplan. Don't think you know where you're going to be in 20 years, because you don't. So a broad set of experiences, a broad set of skills, working with lots of different people, those are the things that will make you flexible and able to address or deal with changes as they inevitably happen in our economy and in our society.
Thank you so much.
Anything else? Oh, go ahead, Mike.
We have one question from online viewer Peter Coy, opinion writer for the New York Times. He says, I think many people are surprised how rapidly the nominal interest rates have gone up around the world. That can be something that sets off some fears in the system. We saw some of this in the UK in their liability-driven sector of the insurance market. He'd like to know if you agree or disagree with that statement.
What was the last sentence?
We saw some of this in the UK in their liability-driven sector of the insurance market.
I just don't understand. What is the question?
He's wondering if you agree or disagree with that statement. that people are surprised how rapidly the nominal interest rates have gone up around the world?
Well, nominal interest rates are a lot higher than they were a few years ago, that's for sure. But on a historical basis, they're not that high. And I think what that means is that the underlying long-term real rate of interest, natural rate of interest, is still pretty low. And what we're seeing is inflation and central bank tightening, raising interest rates up to levels, again, which would have been very unexceptional 20 years ago, but relative to what we've seen in the last decade are obviously higher. A really good question is, where will interest rates be in the very long run? I don't pretend to know, but I think that inflation will come down over time, that the economy will rebalance over time, and when that happens, I think we'll see lower interest rates, perhaps not as low as before the pandemic, but I think we'll see interest rates that are, again, relatively low going forward. Okay.
Okay. Oh.
Thank you. Hi, congratulations. Julie Chabanas, AFP, Agence France-Presse. Just a quick question. Do you think a soft landing in the US is still possible?
It's a very difficult challenge for the Federal Reserve, and I have the confidence in my old colleagues at the Fed that they'll do the very best that they can. They have enormous intellectual firepower to try to figure out exactly what's going on, and they're not only competent, I think, but very independent and very effective in what they do. So I don't know the answer. It is, of course, a difficult situation, but I have a lot of confidence in my former colleagues.
Okay, another question from online.
We've got another online question from Steve Leisman from CNBC. He asks, what have we learned over time about how central banks should address these risks created by the financial system? Should there be limits? Did the Fed do too much? Did you do too little? Is there a way to appropriately calibrate the response?
So I think the question I think is, should monetary policy take into account financial stability risks? And I think part of the problem is the last thing he asked, which is the calibration. I don't think we know very much about how changes in interest rates affect long-run financial stability, and therefore we have a lot of difficulty making trade-offs between the effects of lower interest rates or higher interest rates on the economy versus their effects on financial stability. My recommendation, at least as a first line of defense, as you've often heard, is to have strong regulation. And that is a very focused, targeted approach, which I think should at least be, as I said, the first line of defense. Beyond that, I'm totally open to trying to understand better the links between monetary policy and financial instability. I don't think we understand that well enough yet, except under perhaps extreme conditions, to try to fine-tune financial stability using monetary policy.
Okay. Thank you. Thank you, Ben. Congratulations.
Thank you, everyone.